retirement planning advice. And I think it's just going to be beneficial for anyone who's either looking at a pension for the first time, maybe already has retirement provisions or pensions and wants to make sure that they're getting the best options with respect to them, and maybe people that are gearing up for retirement. So I suppose everybody can just kind of, get a fresh outlook on the options that are available to them leading up to retirement and in retirement, to make sure that they have a good strategy for, I suppose, replacing or supplementing a sufficient level of their income in their later years. Just before we get on to things, for those who maybe have not joined any previous webinars that we've been doing, we have been running a number of them over the last 2 years or so. And the next one we're doing is actually on the 1st of December, which is going to be specific for business owners, company directors and senior managers, just around how you can kind of reduce your tax. We'll be running actually 2 sessions that day. So the first one will be at 1 p.m. and the other one will be at 7:30 p.m. That's the first Thursday, the 1st of December. So if anybody is in that cohort, feel free to drop us a message to get the details. And look, I'm sure we'll be pushing it out from our end as well. Okay. Just to give everybody a quick introduction to who Alpha Wealth are, for those of you who might not know, we run a impartial financial services company headquartered out of a place called Little Island in Cork, and we basically give financial advice to individuals and families and business owners like yourselves in pretty much all aspects of personal finances. So things like savings and investments, retirement planning and pensions, tax advice, protection insurance, and just help them kind of make better decisions with their money. We are a central bank regulated company, which is obviously important. We currently have 8 qualified advisors in Alpha Wealth who have over 60 years of experience between us. Thankfully, we've over 3,000 clients from all around Ireland at this stage that we're adding to on a daily basis. And those clients currently have over 120 million euro of assets under management with us. And I think the important thing for us and you guys is that we are impartial advisors, which means that we're not a tied agent for any of the product providers in the market. So it's about making sure that we're getting the best options for our clients, the most appropriate ones, the best performing ones, the most cost effective ones, without being tied to any providers in the market. So just to crack on with things today, obviously the session is on retirement planning, and I think the first step for everyone is to maybe appreciate the importance of retirement planning, because statistically people will spend somewhere between 20 to 30 years of their life in retirement, or most people, should I say. I had somebody say to me the other day, Jesus, what's the point in retirement planning? I could be dead before I see the money. And I was kind of saying, like, if that's our mentality, what's the point in planning for anything? Thankfully, many of us will, reach retirement, and many of us will spend a very, very long time in retirement. So rather than retirement being an end point, or what was usually thought as a near an end point, it's now actually representing quite a large chunk of our life cycle. And in some people's cases, it can be a third of our life. So it is important to plan for it, of course. So we do need to ask ourselves, I suppose, where our income is going to come from in our later years, and it can come from many different sources. You'll have things like the state pension, then you'll have private pensions, which we might talk a bit about today, or we will talk a bit about today. Some people might decide to work a bit in retirement, maybe part-time, although other people won't necessarily have that option. Then people might have to fall back on kind of other savings and investments and assets. Maybe you have a rental property, and then there's things like getting inheritances and maybe downsizing the family home when the kids have headed off and they're doing their own thing. And I think it's important to maybe ask ourselves, what of these things can we control now? Because look, arguably there's a lot of things that are outside our control here. The state pension is coming under a lot of pressure. Some of us might be forced out the door at a certain age. We mightn't be able to work in retirement. We can't really rely on inheritances. So the things that we can put provisions in place now to cater for retirement planning are things like private pensions and building up our savings and investments. Obviously, the main vehicle for, I suppose, retirement planning for most of us is to contribute to a pension. And I'll be the first one to admit that my industry completely overcomplicates pensions, and many people are just kind of lost in the details. But all they really are is just a long-term savings plan, but one that comes with really good tax benefits. And because of all the tax benefits associated with a pension, it is one of the most effective ways of saving money long-term and accumulating a large pot of money. Now, revenue give us quite generous limits on how much of our incomes we can offset against pension contributions, which are displayed on the, I suppose, the image on the left-hand side here, the bottom left-hand side. So for those who are under 30, they can allocate up to 15% of their gross earnings into a pension and get tax relief up to that level. And that gradually increases to 40% for those who are 60 and over. How pensions work effectively, and apologies for anyone who knows this, is essentially you and your employer in some cases will gradually pay into a fund over the course of your career. Any of the contributions that you make, you get tax relief on them at 20% or 40%, depending on your income levels. The contributions are building up in the fund over your working career, and any interest that is earned on those contributions is also tax-free. And when you come to retirement, which is somewhere between 60 and 65 for most people, although some people might look to retire earlier and some people might look to retire later than that, you get to access part of the pot as a tax-free lump sum, usually about 25%, and then you draw down regular income from the remainder. What I've just described here is like a defined contribution pension scheme. I've decided to ignore a defined benefit pension scheme, which works a bit different. It's dependent on your salary and your years of service, and it is a defined amount at retirement. They are becoming a bit more extinct, so I suppose people nowadays will mainly be kind of, I suppose, contributing to this type of arrangement, which is the kind of long-term savings plan type of pension. There's three main reasons why people would want to start the pension, and the obvious one is to replace our income in our later years. As I mentioned earlier, the state pension is currently coming under a bit of pressure. For many people, it will be their only source of income in retirement if they're not making private pension contributions, and there is a big risk of being over-reliant on that. The state pension currently gives about €13,000 per year payable from 66, and €13,000 is quite hard to live comfortably on. But not only that, it's likely that the benefit will probably be reduced, or the age at which people become entitled to it is going to be pushed out by the time many of us see, our later years. So there is a real importance there on making private pension contributions to supplement what the state pension will provide. The other reason, and the reason a lot of people ignore, is to simply reduce how much tax you pay. If you want to pay less tax, then make pension contributions. It's as simple as that. So as I mentioned earlier, as a top rate taxpayer, you get 40% tax relief on your pension contributions, which means that for every €100 going in, it will only actually cost you €60. So you pay €100 per month, but the net cost to you will be €60. Or if you're a standard rate taxpayer, so that's as of next year, you'll be earning less than €40,000 a year, you'll be getting tax relief on the contributions at 20%. So 100 goes in and it only costs you 80. In addition to that, all of the contributions grow tax-free over your working life. The third reason is to simply save money effectively and accumulate a large pot of money over time, or build wealth. So the guy up on the right-hand side here is Albert Einstein, and he had a very famous saying that compound interest is the eighth wonder of the world. He said, those who understand it earn it, those who don't pay it. So not only do pensions benefit from tax-free, not only do they benefit from compounding interest over very long periods, they benefit from tax-free compounding interest over decades, which adds rocket fuel to people's pensions accounts if things are done right. So they are the most effective way of accumulating a large pot of money over time. And, if you're trying to save in anything long-term outside of a pension, you're going to be far behind what a pension will ever deliver for you. So just to kind of show you, I suppose, the difference that a pension contribution can make relative to somebody's take-home pay, their tax situation, and what they might get at retirement, I've taken two people here, both 55 years of age, earning a salary of €60,000. One is deciding to make no pension contributions, and the other is deciding to contribute 20% of their gross earnings to the pension. So if you take Paula here, who's not making pension contributions, she's coming out with about $3,500 per month. But because she's not making pension contributions, she's losing over €13,000 per year to income tax, or over $132,000 loss over the next 10 years, age 65, which is a very hard pill to swallow for Paula. She's only going to get the state pension, which is currently €13,000 a year at 66. And if she decides to save or invest any of her money from her after-tax take-home pay, the interest on those savings are going to be taxed at 33% or 41%. In stark contrast, if you look at Jason, who's deciding to put 20% of his gross earnings to the pension, he's coming out with a take-home pay of 2,931. So while he's saving 7,200 of his annual take-home pay to his pension account, what is actually hitting his pension account is €12,000 because of the 40% tax relief on the contributions. So he's basically turning 7,200 into 12,000 here before the money is even invested. He's saving 4,800 per year in income tax, or 48 grand saved in income tax over the next 10 years. And he's on track for a pension pot of 165,000 thereabouts at age 65. That's assuming a 5% interest rate, by the way, which I'd like to think is extremely conservative. If anybody is not getting an average interest rate of 5% on their pensions, you need to reach out to someone to make sure that you're in the right arrangement. He's going to get 25% of that pot as a tax-free lump sum, which is about 41 grand here. And then he'll draw the remaining 123,000 as regular income to supplement his state pension. So I have met people in the past who have said to me, I'm too old to start the pension. And you were never too old to start the pension, because if you're saving at all, you might as well be allocating those savings into the pension to make your situation, I suppose, look more like Jason's here rather than Paula's. I think it's important for people to realize the options that are currently available to them when they go to draw down their retirement pots, because the way people have taken their pensions has really changed over the last decade or so. The old way to kind of draw on your pension was to move everything into a cash fund a couple of years off retirement and purchase an annuity, which gave you like a guaranteed income for life. But because of people living longer and because of the fact that annuity rates have been kind of slashed over the last decade or so, the way people are now accessing their pension pots is very, very different. So as I mentioned earlier, you'll get to access part of your fund as a lump sum, which is 25% of the fund in this case. The first 200,000 of that is tax-free. So if you have a pension pot of 800,000, 25% of that is 200 grand. All of that is tax-free into your bank account, no questions asked. The next 300,000 is actually then taxed at 20%. So for example, if somebody has a pension pot of 2 million, let's say, they will be able to take 500 grand as a tax-free lump sum. The first 200,000 will be tax-free, next 300 grand tax at 20%. So you can get quite a lot out of your pension in a very tax-efficient manner. Then we're left with the 75% that's in the fund, and you have two options really regarding this. The first is to put it into something called an approved retirement fund, or an ARF. And this is probably what over 95% of people do with their retirement pots nowadays. And all it simply is you just kind of keep the monies within a pension fund. You can continue to invest it, and you decide how much you want to draw out on an annual basis to supplement or replace your income. If anything happens to you, the value of the ARF is passed on to your family, okay? The older way of drawing a pension, and one that a lot of people still do, to be fair, is called an annuity, where basically you exchange the 75% that's left in your pension pot in exchange for a guaranteed income for life. You can also do a combination of both, or if you go with an ARF, some or all of it can actually be exchanged for an annuity down the line. It's important to note as well is that if anyone on the call is a proprietary director or company director, you have an option to take 1.5 times salary as a lump sum rather than the 25% calculation here, but then you have to put the balance to an annuity. So you can actually potentially get a much higher tax-free lump sum doing this calculation as a company director by bumping up your salary in the couple of years before retirement. The pros, I suppose, of annuities, which is the regular income for life guy, is that you do get guaranteed income for life. There's no longevity risk, which is, I suppose, the risk of you outliving your money, and there's no investment risk. So that sounds great in theory, but the downsides of annuities is that the rate that people are getting on annuities has significantly reduced over the last number of years. So they're arguably very poor value for money at the moment. The table over here on the right hand side just shows what typical annuity rates are at the moment. You know, they're in and around the 3-4% depending on what age you're retiring. So if you look at a 65-year-old here, he's only getting guaranteed income of €3,900 per year on each 100 grand that's left in his pension, which in a lot of people's cases, a lot of people's opinions is poor value for money. There's also no flexibility you know, that is defined. The amount of income that you get is set, although you can, you know, pick options where it would rise in line with inflation, but that comes at getting a lower rate. Whereas if you go with the approved retirement fund option, it's up to you completely with how much you draw out on an annual basis. So you have a lot more flexibility there. And with an annuity, I suppose one of the big downfalls and one of the reasons that a lot of people are turned off them is there's generally no long-term capital preservation for dependents. So if you live to 120, annuities are great because you've been getting the income every year. But if you die after a couple of years, in a lot of cases, you're kind of at a loss and there's nothing left over for your dependents. Approved retirement funds on the other case are, as I said, you kind of just leave the money in a pension fund. You continue to invest it partly if you wish to do so. It is advisable to do so, and you draw down a regular income from the fund. It gives you a lot more flexibility, as I said, because you decide what level of income to draw out. So you, in most cases, you have the potential to get a lot more income than what an annuity would provide. And at that case, I suppose it's trying to reach a balance between preserving your fund for as long as possible and getting you the ongoing income that you need. And because of that flexibility, it actually allows for better tax efficiency. So I mentioned earlier that people earning up to 20 or up to 40,000 euro a year pay tax at 20%. Those who earn over that pay tax at 40%. So with an ARF, you can decide how much you draw out of it to avoid paying too much tax at the top level. And I suppose one of the main selling points for it as well is that if you die, your dependents or your next of kin inherit the full value of the ARF on death. So there is that capital preservation there. The cons, of course, that come with it is you do have to invest the money, or it is advisable to do so. And therefore, that brings investment risk into it. And then, of course, you have the risk of running out of money. If you took, say, 20% of your value per year, then your fund is not going to last very long. As we mentioned at the start, people are living a lot longer. If you look at 2000 here, the average mortality rates for males was age 74. And if you fast forward to 2017, we're up to age 80. So men have actually added about 6 years to their lives over the last 17 years or so. Women are still outliving us. As you can see here, the average mortality rate at 2017 for females is actually 84. Now, obviously, in 2022, you'd expect them to be slightly higher. But this just shows that as time goes on, people are living a lot longer. So we are spending more of our lives in retirement. And because of that, pension assets need to be partly invested throughout our retirement to make sure that we're preserving our income levels and keeping pace with inflation, particularly while deposit interest rates are 0% per year. So what you have down here on the left-hand side is a rating of risk and reward. So over someone's life cycle or their retirement planning cycle, it would be advisable that they would start off in pension funds that would be mostly invested in growth assets. So like risk level 5, risk level 6, so higher risk, higher reward investment funds. And as time goes on, we would de-risk your portfolio and move you down into lower risk, lower reward funds. Now, the old way of thinking, as I said, is that when somebody was in their kind of late 50s or 60, they would essentially be in like a risk level 1 or a risk level 2 fund, as to completely remove any investment risk and then exchange all their pension pot for an annuity. But as I said, the way people are accessing their pension pots nowadays is very, very different. So even somebody who's in their 60s drawing down their pension fund could potentially have a 30-year investment horizon ahead of them. So it makes no sense having all their money in a low risk or a cash fund at that point, because they'll still need to invest it over the next couple of years. So it's now, I suppose, vital to get proper financial advice even throughout retirement. So we're finding the right balance between growing and preserving your fund, managing your risk, and maintaining your regular income levels. This just, I suppose, reinforces why it is so important to invest your money throughout retirement. And it comes down to our friend inflation that we're hearing a lot about at the moment. So if you take Michael in this case, who decides to stick 100,000 into a cash fund, the impact that inflation is going to have on his money over the next 15 years is set out in the blue box below. Now, the monetary amount of Michael's fund is going to remain level. He's always going to have 100,000. But what I mean by that is the purchasing power, or the real value of it, is going to be eroded by inflation as the price of goods and services is increasing. So at 2% inflation rates, his 100 grand is reduced to about 73,000. At 3% inflation rate, he's down to about 63,000. At 4% down to 54, and at 5% inflation, we're seeing in excess of that at the moment, he's down to 46,000. So you can see how devastating inflation is over longer periods of time, which is why it's so important to make sure that your assets are invested, if you have a long horizon ahead of you, to make sure that they are keeping pace with inflation. If you, I suppose, compare that to investing in equity markets, even though they rise and fall daily, weekly, and monthly, that is very normal. It's part of the natural cycle of investing. But historically, every time we have a market downturn, it is temporary and it's usually followed by an eventual upswing. Many people's pensions are invested nowadays in something called multi-asset funds, which is basically a very, very well diversified, well managed portfolio, which is giving you exposure to hundreds of different assets spread out right across the world and managed by a fund manager. But there's never been a 10-year rolling period in history where multi-asset funds have produced a negative return. So again, if we're looking at, a 65-year-old who's expected to live to 85, that's a 20-year period. They should really be invested in something like a multi-asset fund. There is, I suppose, a bit of a misconception out there that everyone lost all their pensions in 2008. It is true that some people did lose their pensions in 2008, and a lot of people might have lost a portion of their pensions in 2008. But as I said, nowadays people are invested in very, very well diversified funds, which even though it might have went through very, I suppose, turbulent times in 2008, it would have made that back and recovered. So let's just look at the right-hand side bottom here. If you invested in the US stock market right before the 2008 financial crash and stayed invested for 8 years, you can see here that even though the value would have fallen quite sharply in 2008, by 2015, you would have experienced a total return between 2007 to 2015 of 42%, which just proves that people that remain in the market over longer periods of time are always rewarded. And even the worst investment periods, if you just hold and stay invested, you are rewarded. The S&P 500, by the way, for those who don't know, is I suppose the top 500 companies in America. It's usually a good representation of what the stock market would look like. Just on, I suppose, choosing investment funds then and making sure that you are in the right investment funds, it is really important to get impartial advice on your pensions and review them regularly. And the reason I say that is that there is loads of brokers in Ireland who are all dealing with loads of different providers, and all of those providers have loads of different funds. So there's hundreds of funds that you guys can choose to invest your pension assets in. And unfortunately, there is a huge difference between what's on offer and what some of the funds are, I suppose, returning versus others. So this just compares 5 different risk level 4 funds, which would be a moderate risk fund, over the past 5 years. So we're looking at Zurich, Irish Life, New Ireland, Aviva, and Standard Life, 5 of the biggest fund managers in the Irish market today. You can see Zurich's Prisma 4 fund returned nearly 40% over that 5-year period. Now it is a bit less than that now. This was taken from a couple of weeks back as markets have kind of seen further declines over the last couple of weeks. But the Prisma 4 up to this point had done 40% over the 5-year period prior to that. If you look in contrast to that, Irish Life, same risk level fund, 23% nearly, New Ireland, 25%, Aviva, 18%, and Standard Life, 26%. So Zurich in this case have actually doubled the returns of some fund managers, nearly doubling the returns of others over the same period for putting investors in a similar risk level fund. So it's really important that you're getting exposure to the best options out there and getting impartial advice from people that deal with all the providers and aren't just tied to 1 or 2 of them. And it's really important as well to make sure that you're aware of any charges on your pension funds, because they can really eat into investment growth. It is possible to transfer your pensions in most cases, and if anybody wants to look into that, we're more than happy to review your pensions and help you on that front. So a common question people will ask me, how much of a fund value should I ideally have at retirement? And firstly, let me just stress that it is a case-by-case basis, okay? But I find that the sweet spot when looking at our average client situation today is a fund value of about 600 to 800 grand. I respect that some people can live on less than that, and I respect that some people will want a lot more than that, but I think that's kind of the sweet spot for our average client that we're dealing with. While that might seem like a very large pot to some people, you need to remember that that potentially has to last you 20 to 30 years. The reason I say that is that if you have a pension pot of 800,000, firstly, it'll give you the maximum allowable tax-free lump sum of 200,000, which is 25% of the fund. You then have 600,000 left in your approved retirement fund, of which you're going to draw down an annual income from. A typical drawdown rate will be about 5% per year, which would give a 30,000 euro income per year on the remainder, in addition to the 200 grand tax-free cash. If you have a pension pot of 600,000, you're coming out with a tax-free lump sum of 150 grand. You're left with 145,000 in your ARF. So again, if you decide to take 5% per year, that's going to give you 22,500 per year. What we also need to add on to that is the state pension, which I did say earlier that it might not fully be there at 66, but it currently is, providing an additional 13 grand a year from 66. And what a lot of people ignore is that lump sums can also be used to to supplement your income further. So you could place, say, your 200 grand in a fund and draw a further 5% a year from that. So basically, if somebody has a pension pot of 600 to 800,000, I'd like to think that in today's terms, after inflation is accounted for, they should be on track for a retirement income of somewhere between 30 to 40 grand a year, which I'd like to suggest should provide a comfortable life at a point where mortgages and loans will likely be cleared off and kids will no longer be dependent and life might be a little less expensive. So how do you accumulate a pension pot of 600,000? What that would be is net contributions of 356 euro per month over a 30-year period, earning a conservative enough interest rate of 6% per year. That would effectively be 10% of a 45 grand salary being contributed to a pension. Now, a lot of people on this call might be in a company matching pension scheme with your employer, which means that if you're 30 and you're on a salary of 45 grand a year, that would be 5% from you and 5% from your employer to reach a fund value of 600,000 on these assumptions. And we need to appreciate as well that income levels or salaries will naturally increase over time. So it is much more achievable than people think. This is a very wordy slide, so apologies in advance, please do bear with me, but this is just kind of setting out what can be achieved by contributing a certain level. This is a pension projection I actually done with a client recently, and look, it'll just kind of give you a clear sense as to how a pension journey works. So you take Norma here, who's a 30-year-old earning the 45,000 per year, and she decides to put 10% of her gross earnings to a pension with her employer matching 5% to age 65. Now, this is based on certain assumptions. We're assuming that the contributions are going to increase by an average of 2% per year, which is realistic. They're not going to stay level over a 35-year period. And we're assuming a very conservative average growth rate of 5% per year. So what this looks like is that Norma's employee contribution will be 375 euro per month. The employer contribution will be 187. So she's getting 562 euro hitting her pension account every month. Now, remember, Norma is actually not paying 375 in net terms because she's getting 40% tax relief on that as a top rate taxpayer. So what it's actually costing her is only 225 euro. So basically, Norma is saving 225 euro of her take home pay each month, yet she's getting 562 euro hitting her pension account, which is 150% return even before the money is invested. And this is what I was referring to earlier as, the power of pensions and why it does not make sense using any other vehicle to plan for your retirement rather than a pension. You show me another investment where you could potentially give me 225 and it could turn into 562 before the money is invested. So based on these assumptions, she's due to come out with a pension pot at 65 of about 840 grand. She's going to take 25% of that as a tax-free lump sum, 25% as a lump sum being 210,000. Remember, the 200,000 is tax-free and the small balance of 10 grand is taxed at 20%. So she's coming out with 208,000 net lump sum. She's left with 632,000 in the fund, which she's going to draw down as a regular income in retirement. And remember, many people's tax positions in retirement will be very different to now. Most of us will be paying a much lower tax rate in retirement. So assuming she takes 5% per year from that pot, she's coming out with 31,602 euro per year. Now, we do need to discount that to allow for inflation. So in today's terms, it's going to be more like income of about €15,800 per year. She's going to get the state pension on top of that from 66 a year later. So that's 13 grand a year in today's terms. So in total, Norma is going to come out with about €28,800 in today's terms, which is 64% of her pre-retirement income for just allocating 10% of her gross income to a pension. And remember, she's going to have 208,000 in cash, which can be drawn down further to supplement her income. If she takes 5% a year from the lump sum, that's an additional 10 grand a year. So Norma could potentially be replacing over 70% of her pre-retirement income with pension income for only contributing 10% of her gross earnings to a pension. Now, as we're coming up to the 31st of October tax deadline, I think it's important for people to realise some of the opportunities that they have with regards to making a pension contribution from personal funds before that tax deadline. So believe it or not, you can actually make a contribution to your pension and backdate it to last year, 2021, as to reduce your tax bill from that year. So if, for instance, you have, let's say, €10,000 in your savings account, which you do not need, you can transfer that €10,000 to your pension and then go online and include it in a 2021 tax return. So amend the 2021 tax return if you've already done it, but you have to do it before the 31st of October, which is, less than 2 weeks' time. So within a few days, Revenue will rebate you €4,000 back into your bank account on that 10 grand, which makes the net cost of the contribution just €6,000. That's a situation with a top rate taxpayer. If you're a standard rate, you'll be getting 2,000 back. So the full 10,000 arrives into your pension, which grows tax-free to your retirement, yet you get 4,000 back into your bank account. When I describe this situation to a lot of people, they kind of say, "What's the catch?" And I can assure you there is no catch. So if anybody has, vast sums of money sitting, well, not even vast sums, but, large amounts of money on deposit that they don't foresee them needing in the long term, it's worthwhile maybe doing this to reduce your tax bill, bump up your pension account, and get a good return on your money. I mentioned earlier that we're doing a webinar for company owners and directors on the 1st of December, but this is just kind of a small snapshot of the options that are available to company directors. So bear with me for anyone who is not in that category. So what do we do with company profits? So if you have, I suppose, money sitting in your company account and you're coming up to your company year end, you basically have 3 options with regards to taking that money. The first option is to draw it as salary, where you're going to lose 50% of it to top rate income tax, USC and PRSI, if you're breaching over the standard rate threshold, and it actually costs the company 11% to pay you that. So, for example, you take €1,000 out of your company, what you actually receive into your bank account is about €408, and it costs the company 1,100 or over that to pay you that €1,000. The other option is to leave it in the company account, where you're going to lose 12.5% of it to corporation tax, possibly face negative interest rates on corporate deposit accounts, and possibly pay close company surcharge. The other option is to put it into your pension, where the full amount would arrive into your pension, grow tax-free to your retirement. There's no income tax or BIK in your hands, and there's no employer PRSI in the hands of the company. So a very, I suppose, efficient way of extracting money out of your company in a tax efficient manner. And directors have massive scope to fund a pension. So with company directors, they can actually make special contributions for any years that they didn't max out their pensions. So for example, if you take care of a 60-year-old company director who started a company 20 years ago and never ever made a pension contribution, and they want to retire at 65, they could make contributions of nearly €12,000 per month, which is €138 per year. These are seen as ordinary contributions. But as I mentioned, they can also make a special contribution for years that they didn't fund their pension. So if they're going with a special contribution, they can squeeze over 550,000 from the company account into their pensions, in addition to €26,904 per year. And RC is that they can make a matching special and ordinary contribution of 115,000. So as you can see, there's quite vast scope for company directors to fund their pensions and get money out of the company account to avoid paying too much tax. Now, what if you have no scope to fund a pension, as in you don't have, enough income to offset against contributions, or you have limited scope to fund your pension, as in you're already maximizing what can be put into a pension? There's two options that I would encourage people to consider. The first is to put money into an investment savings plan, which kind of works like a pension just without the tax benefits. And the other is a tax back scheme called the Employment Incentive Investment Scheme. So the investment savings plan I'm going to talk about today is actually offered through Zurich, who I believe are the best fund manager in the Irish market. And the plan they have is called the Easy Access Savings Plan. It's ideal for any medium to long-term savings, even kids savings. We would set them up quite a lot for our clients who want to save their child benefit for kids' college, but they can also be used effectively for retirement planning for people that have limited or no scope to fund pensions. So they basically allow you to save from as little as €100 per month upwards, or lump sums of €5,000 or more. They're very flexible in that you can increase, decrease, stop and restart the contributions at any stage. The term is completely open-ended, so you can access your money at any stage, and you have access to a very wide range of market-leading and award-winning investment funds, the same type of funds that you can invest your pension in, although you can just access the money at any stage. And like a pension, that risk level can be changed throughout. So it's just allowing your savings to get a better return and grow, and accumulating a pot of money to maybe aid your retirement alongside your pension. The other scheme is a tax-back scheme called the Employment Investment Incentive Scheme, or EIIAS for short. It is a revenue-backed scheme which basically allows top-rate taxpayers to invest sums of money with qualifying Irish companies who are raising capital, typically over a 4 to 5 year period. The minimum amount that you can invest is usually about €5,000 per company. And there's hundreds of companies every year that will use EIS as a way to raise capital, rather than looking at like venture capitalists or private equity or going to the banks, because it's a very cheap and efficient way for companies to raise capital without giving up any control or equity. Now, the incentive for a taxpayer or an investor is this: revenue will give you a 40% tax rebate on any investment that you invest with a qualifying EIS company to offset against your income arising in that year. So the relief is the same relief that you would get on pension contributions, but the term is much shorter. In addition to that, you also get a return from the company for the use of your money over that 4 to 5 year period, which is usually in the region of about 20 to 30%. So just to, I suppose, throw some figures on that and what it might look like. If you, for example, invested €10,000 in an EIS company this year in 2022, next year in 2023, revenue would issue you with a 40% tax rebate on that investment amount. So you have €4,000 coming back to you on an investment of 10 grand, making the net cost of it just €6,000. Then in year 4, assuming it will, I suppose, mature in year 4 in this case, so 2025, you'll get your initial 10,000 returned, plus an interest rate, which we'll assume to be 28% in this case. So you have 12,800 coming back to you on an investment of 10 grand, and then you add on the 4,000 that you've got back from revenue. So an investment had a net cost of just €6,000, and you're being returned 12,800 after a 4 to 5 year period, which is a double your money scheme if done right. But it is important that you pick, solid companies. There's loads of companies, as I said, that are raising capital every year, and this is an example of one of the companies that are raising money this year under EIS. There are a lot of kind of early stage startup companies, but there are some really solid established companies here. And I see Blacks of Kinsale as being one of the best options out there in the EIS space at the moment. They are a beer and spirits company established in 2013. The company is presently valued at €15 million. Their revenues last year were over 2 million. They've won many, I suppose, awards for their craft beer, whiskey, gin, and rum offerings. I do believe they're in a very supportive market. So, like Irish whiskey, for those of you who don't know, is currently the fastest growing spirit worldwide, and the craft beer market has absolutely exploded in the last couple of years. The reason they're using the EIS funds is to build their new distillery and brewery in Kinsale. I believe it'll be the first multi-distillery and brewery site in Ireland, so in the same location. And they're paying a 28% capped return plus the 40% tax relief to investors under the EIS scheme. If anybody does want to find out a bit more information on that, please do feel free to reach out. So look, that's everything for today's webinar. Look, I hope you got some benefit from it. I do want to thank everyone for your time. This is just some of the other areas, as I said from the outset, that we can help people with, you know, things like savings and investments, protection and mortgage reviews, pensions and retirement planning that we dealt with today, and more kind of specialist areas like estate and succession planning. So if anybody would like to book in for like a financial planning consultation to look at all areas of your kind of personal finances and put a plan in place to help you achieve your goals, we'd be more than happy to help there. And my own contact details are on screen there if anybody wants to take them down or take a screenshot. So look, thank you for your time, and I will open it up to Q&A now. I know we got some questions in over the last couple of weeks.
Hi, David. Can you hear me?
Yeah. Hi, Cliona.
I have some of the questions here, so I'll run them by you if that's okay. So given the current environment, how do you know, or how do I know, should I say, if my pension is invested in the right funds?
Yeah, so if you're in like a company pension scheme, sorry, you can reach out to the pension provider or the pension consultant, and they'll be able to provide you some information on what funds you're invested in, and feel free to get a second opinion, I suppose, on that from, I suppose, an impartial broker advisor like ourselves. And like the key thing to stress there is your pension fund should really be dictated, but with on the basis of how long away you are from your retirement date. You shouldn't really leave current events dictate where you're invested in. So what I mean by that is somebody who's, you know, 30 retiring at 65, you should really at this point be invested in high risk, high reward funds, irrespective of what's going on in the world at the moment. You know, we're always going to have kind of short-term challenges, but you do want to make sure that those funds are performing versus their peers and the market, so you can get some information and a second opinion on that.
Very good. And I suppose this kind of leads on to the next question. Is now a good time to set up a pension, or should I wait for the market to settle?
Yeah, so like, good question. Just going back to what I said on the earlier question, you know, you don't really leave current events dictate your financial planning or your retirement planning, but it is actually, as things stand, an excellent time to be investing, because the market is down quite a lot over the past year, which means that when you are buying into pension funds or investment funds, the value of the units in the fund have fallen over the last couple of months, which means you're now getting more bang for your buck. Essentially, you're securing more units in those investment funds. You know, you're buying while prices are low. So it is an excellent time to be investing money, starting a pension or starting a savings plan. But in the same breath, you know, it's impossible to time the market. So it's about keeping the long-term view in mind and looking at the average return that's generated on your portfolio or your fund over a long period of time, rather than getting too fixated with what's going on in the short term.
This question then is around self-employed. So I am self-employed. Is the pension different for me from a PAYE person?
Yeah, good question. Yes, potentially, but it depends whether you are a limited company director, as in you run a limited company, or you are a sole trader. If you are a sole trader, the option is usually something called a personal pension or a PRSA, where you will pay the contributions from your account, and then you will, I suppose, claim the tax back from revenue separately in your tax return. Whereas it's basically the same option that's available to PAYE individuals who don't have access to a company pension or an employer pension. Now, if you're a company director, the option is a bit different, in that you would be setting up what's called an executive pension, or potentially a group company pension scheme if there's a couple of you involved. And in that case, the contributions are paid directly from the company account. So rather than you suffering tax on your salary, paying after-tax salary to the pension, and then claiming the tax back, you would just be plugging money directly from the company account into the pension.
I have an old pension from a previous employment. Should I do something with it or leave it as is?
Yeah, good question again. I'm not a big fan of people leaving pensions behind in old employments. Okay, if they've like moved on from the company, just because there's kind of a bit of a lack of transparency or control or management there. The obvious one as well is like, you don't want to be tracking down your old employer saying, you know, remember me, I used to work for you 20 years ago. Do you mind if I access my pension? So what I usually recommend people do is maybe to transfer them to something called a personal retirement bond, which basically just moves it into something in their own name. The incentive of doing that is that you can pick any fund or any provider in the market you want. So you can make sure that you're seeking out the best option rather than being restricted to what your old scheme provides. And you do get to access personal retirement bond funds from age 50 onwards as well, whereas a lot of company schemes typically don't allow you to access from age 60. So you could potentially access the funds from 10 years earlier, get better management and get better returns, more flexibility moving to like a personal retirement bond. The other option is to move it into maybe your new employer scheme, which I wouldn't be a big fan of, because like a lot of people think it's good to amalgamate pensions, but it can actually be quite advantageous to have a couple of different pension pots, because you can retire them at different points in time and kind of maximize your tax efficiencies there. If you move it into your new scheme, it's going to be locked away until you either leave that company or retire it from it. So it's probably best to keep it separate. So maybe the personal retirement bond is the best option there. And we can review old schemes for people by sending like a letter of authority to the provider and getting an overview of the details and the options and provide advice on it.
Great. The second part of that question was just this person asked about booking a review and how can they go about that and what documents are needed.
So like anyone we deal with, I think I usually recommend that they come in and talk to us and schedule what I call is a full financial planning consultation, where we will look at all aspects of your personal situation, your financial goals, and then put a plan in place to help improve your financial situation, improve your financial future, and make sure that you're in the best place. You know, we'll try to save you money, we'll try to reduce how much tax you pay, and basically just kind of put a clear plan in place for your future. It's just a case of getting a meeting in the diary. There's a couple of bits of information to be provided prior to that, like, you know, your names, date of birth, your income levels, I suppose, have you any dependents where you're working, etc. In terms of gathering details then on existing plans and policies, we make that really easy and hassle-free, because we can send something called a letter of authority to all your plan providers, and they'll send us an overview of what's going on there. So you don't have to be, you know, digging out any old, I suppose, pages at home on policies. We do charge a once-off consultation fee of $199 for that full financial planning review. But as we always do for anyone who's comes onto our webinars, we do offer them a discounted rate, 50% off. That's so it would just be $99 for the full financial planning review. And in my experience, we generally do save people thousands from that process. So it's well worthwhile.
Very good. Can you top up a personal retirement bond?
No, personal retirement bond is essentially just kind of a paid up pension. So the monies just kind of sit there, they continue to be invested, they grow tax free. And when you reach your retirement age, or whenever you want to access it, as I said, from 50 onwards, you take some of it as the 25% lump sum and then draw down income from the remainder. But it's the same situation if you don't move into a personal retirement bond. Like, you can, if you leave a company, you can't contribute to the scheme anymore anyway. So your options there for funding going forward would be your new employer's company scheme, if there's one available, or else setting up like a personal pension or a PRSA. So you'd essentially have maybe two separate pensions: the personal retirement bond, which is kind of paid up, and then the new scheme that you're making ongoing contributions into.
This is the last question. I think you actually covered it during the presentation, but I'll just run it by you anyway, just to give this person clarification. What happens to my pension if I die?
Yeah, good question. So if you die before you retire, in most cases, the full value of your pension pot is actually paid out as a tax-free lump sum. And I think that's really important as well, because like when I'm doing protection reviews with clients, it's important to know what you have first before looking at new like protection policies. And a lot of people forget that pensions are paid out on death. So in a way, they can kind of act like a form of life cover. Now, if you are already after retiring the pension, okay, obviously you would have taken your lump sum, which is cash in the bank, and that goes to your spouse or your dependents. Naturally, if you went with the approved retirement fund option, your dependents or your spouse would inherit the approved retirement fund. Now, if you went with the annuity option, in some cases you can add like a spouse's pension. So if you die, your spouse could take over the annuity payments, but sometimes they're only for certain periods. So there is a risk that they might get nothing if you're going with the annuity. But you basically, look, what I'm saying is you can put provisions in place to make sure that if you die, your dependents will benefit from whatever's in your pension. And that's the key message.
Great. I think that's it with the questions, David. Thank you.
Great stuff. Thanks for that, Cliona. Look, and thanks for anyone who sent in a question and for everyone's time.